The market, a complex symphony of human emotion and cold calculation, rarely reveals its true intentions at a glance. Many are lured by its superficial movements, chasing fleeting trends and falling victim to its deceptive simplicity. But beneath the surface, a profound struggle unfolds, a battle of supply and demand that dictates every twitch and surge. To truly master this arena, one must learn to decipher the subtle cues, the hidden signals that betray the genuine intentions of its most powerful participants. This is the realm of market pressure, a concept often misunderstood, yet absolutely critical for anyone daring to navigate the treacherous waters of financial trading and investment. The challenge lies not merely in observing price or volume, but in synthesizing these disparate elements into a coherent narrative of underlying strength or weakness. It demands a deeper intuition, a systematic approach to peel back the layers of market noise and perceive the true direction, the concealed maneuvers of those who move markets. Edson Gould, a name synonymous with incisive market analysis, understood this fundamental truth better than most. He recognized that the market's true story is not told in isolated data points, but in the intricate interplay of its core components, revealing the unseen forces that drive its every breath. Before we continue, please subscribe and leave a quick comment, even one word. This small action helps the algorithm show this video to more people and tells me these deep dives are worth making. And remember to return to the channel in difficult times when trading isn't well. Edson Gould's methodology provides a robust framework for understanding this elusive concept of market pressure. It posits that market pressure is far more than a simple reading of price action or a cursory glance at trading volumes. Instead, it is a comprehensive aggregation of factors that collectively highlight the dynamic imbalance between the forces of demand and supply. It encompasses the urgency of buyers, the desperation of sellers, the liquidity available, and the conviction behind every trade. Gould understood that a rising price, for instance, does not inherently signify strong buying pressure if that ascent is not corroborated by other underlying indicators. Similarly, a declining price might mask a significant accumulation phase if the selling pressure is weak and easily absorbed. The true essence of market pressure, as Gould articulated, lies in discerning these subtle nuances, in recognizing when the market is truly poised for a sustained move, or when it is merely oscillating within a range, awaiting a more decisive catalyst. Understanding this nuanced definition of market pressure is paramount because it serves as the foundational key to accurately forecasting future price movements. Price, in its purest form, is merely a historical record of transactions. It tells us where the market has been, but not necessarily where it is headed with conviction. Market pressure, on the other hand, delves into the why behind the price movements. It seeks to quantify the conviction, the aggression, and the underlying commitment of market participants. When buying pressure decisively overwhelms selling pressure, prices are compelled to rise. Conversely, when selling pressure gains dominance, prices are pushed lower. The magnitude and sustainability of these pushes and pulls are what Gould sought to measure. Without this deeper understanding, traders and investors are often left reacting to events rather than anticipating them, constantly playing catch-up in a market that rewards foresight. Many rely solely on technical analysis, dissecting chart patterns, indicators, and oscillators. While these tools offer valuable insights into market structure and momentum, they often fall short in capturing the full spectrum of market pressure. Technical indicators, by their very nature, are often lagging or coincident. They tell us what has happened or what is happening, but they struggle to reveal the intensity of the underlying forces driving those movements. For example, a break of a resistance level might appear bullish on a chart, but without understanding the market pressure behind that breakout, the conviction of buyers, the liquidity, the order flow, it could easily be a false signal, a head fake designed to trap unsuspecting traders. Gould's approach highlighted the critical shortcomings of a purely technical view, advocating instead for a methodology that integrates the observable actions of market participants with the deeper, often hidden mechanisms of supply and demand. This holistic perspective is what truly differentiates informed decision-making from mere speculative gambling. Edson Gould's genius lay in distilling this complex interplay of market forces into a practical, actionable framework. The three-step rule for reading market pressure. This rule provides a systematic method for analyzing the market's pulse, moving beyond superficial observations to uncover its true intentions. Each step is designed to complement the others, creating a powerful synergy that offers a comprehensive and robust view of market dynamics. Step 1. Analysis of trading volumes. Volume, in Gould's view, is far more than a simple measure of activity. It is a critical indicator of the strength or weakness behind a price movement. Imagine volume as the fuel for the price engine. A powerful engine with abundant fuel can cover significant ground. A weak engine with little fuel will sputter and stall. Similarly, a strong price move, whether up or down, that is accompanied by high trading volume suggests genuine conviction and broad participation. This indicates that a significant number of market participants are agreeing on the new price direction, lending credibility and sustainability to the move. Conversely, a price move on low volume raises a red flag. It suggests a lack of conviction, minimal participation, and often implies that the move is not supported by the broader market. Such moves are often unsustainable and prone to rapid reversals. The significance of anomalous volumes cannot be overstated. Gould taught that paying close attention to unusually high or low volumes at critical junctures, such as market highs or lows, or during purported breakouts, can provide profound insights. For instance, exceptionally high volume occurring at a market peak, especially after a prolonged uptrend, can signal an exhaustion of buying interest or a significant distribution phase where large players are offloading their positions to eager latecomers. The market, having absorbed all available demand, may be poised for a reversal. Conversely, very high volume at a market low can indicate capitulation selling, where all those who wanted to sell have finally done so, paving the way for a potential rebound as new buying interest emerges. Similarly, a breakout above a key resistance level or below a support level on low volume is often a deceptive signal. It suggests that the price movement lacks the necessary conviction and broad market participation to be sustained, making it a high-risk scenario for traders who might be tempted to jump in. Such false breakouts are common traps, designed to lure in unsuspecting participants before reversing course. Beyond these specific scenarios, volume analysis also serves as a powerful tool for detecting hidden accumulation or distribution. This involves observing the relationship between price and volume over time. During an accumulation phase, large institutional investors quietly buy shares, often without causing a significant price increase. This can manifest as periods of sideways price movement accompanied by subtly increasing volumes, or even declining prices on diminishing volume, followed by periods of higher volume on up days and lower volume on down days within a range. The market is absorbing supply without displaying overt strength. Conversely, during a distribution phase, large players are systematically selling their holdings. This might appear as price struggling to make new highs despite increasing volume, or a series of higher prices on lower volumes, followed by significant volume on down days. The key is to look for divergences, when price action seems to tell one story, but volume tells another. If price is rising but volume is declining, it suggests that fewer participants are willing to push prices higher, indicating underlying weakness despite the outward appearance of strength. This careful, nuanced interpretation of volume in relation to price is fundamental to Gould's first step. Step 2. Assessment of bid-ask spreads. The bid-ask spread, often overlooked by retail traders, is a microscopic window into the immediate forces of supply and demand. Gould recognized its profound role as a real-time indicator of liquidity and market volatility. The bid price is the highest price a buyer is willing to pay for an asset at a given moment, while the ask price or offer price, is the lowest price a seller is willing to accept. The difference between these two prices is the spread. A narrow spread typically indicates high liquidity, meaning there are many buyers and sellers actively participating, and transactions can occur easily without significantly impacting the price. A wide spread, on the other hand, suggests lower liquidity, where fewer participants are willing to trade at current prices, or a significant imbalance between aggressive buyers and sellers. Interpreting the expansion or narrowing of these spreads provides crucial insights into the evolving market pressure. A widening spread often indicates increasing uncertainty or a significant shift in the balance of power. If the spread widens during a decline, it could mean that sellers are becoming more aggressive, willing to accept lower prices immediately, while buyers are pulling back, hesitant to commit. This signals growing selling pressure and potential acceleration of the downtrend. Conversely, if the spread narrows during an uptrend, it suggests increasing liquidity and more equilibrium between buyers and sellers, often indicating a healthy, sustainable ascent. However, a rapidly narrowing spread at a significant price level could also imply that aggressive buyers are quickly absorbing all available supply, potentially leading to a sharp upward move, or that aggressive sellers are overwhelming demand, leading to a sharp downward move. The context of the price action and volume is vital here. Gould emphasized using the bid-ask spread to identify the actions of large players and their immediate impact on price. Large institutional orders, when executed, can significantly influence the spread. If a large buyer enters the market with a market order, an order to buy immediately at the best available price, they will lift the offer, consuming all available shares at the ask price and potentially pushing the ask price higher, thereby widening the spread as they absorb liquidity. Conversely, a large seller using a market order will hit the bid, consuming all available bids and pushing the bid price lower, also widening the spread. Observing these instantaneous changes in the spread, especially in conjunction with bursts of volume, can reveal the presence and the immediate intentions of these powerful market participants. When large players are aggressively buying, they will reduce the available supply at the ask, pushing the ask price up and potentially widening the spread. When they are aggressively selling, they will reduce the available demand at the bid, pushing the bid price down and also widening the spread. This real-time visibility into the order flow dynamics, though often subtle, provides a powerful confirmation or contradiction of the signals derived from volume and price action. It allows for a granular understanding of who is truly in control at any given moment, and with what level of urgency. Step 3. Interpretation of price dynamics and their interrelationship. The final step in Gould's rule brings together the insights from volume and spread analysis, integrating them into a coherent understanding of price action. Price action in this context is not merely about recognizing traditional chart patterns, but about analyzing how prices move, their speed, their momentum, and their relationship to the underlying volume and spread data. It involves scrutinizing the candles or bars themselves, their size, their wicks, their closing positions, to gauge the immediate outcome of the battle between buyers and sellers. A long bullish candle closing near its high, accompanied by high volume and a tightening spread, speaks volumes about aggressive buying pressure. A short bearish candle with a long upper wick, on low volume and a widening spread, signals potential exhaustion and selling pressure. Crucially, Gould highlighted the importance of identifying divergences between price and volume as potent warning signals. A classic example is when price makes a new high, but the corresponding volume is significantly lower than the volume that accompanied the previous high. This divergence suggests that the buying interest supporting the new high is weaker, fewer participants are willing to push prices higher, and the upward momentum is waning, even if the price itself appears strong. This is a clear indication of decreasing buying pressure, despite the apparent bullish price action. Similarly, if price makes a new low, but volume is not increasing significantly, it might indicate a lack of strong selling conviction, suggesting that the downtrend may not be sustainable or that sellers are becoming exhausted. These divergences are often harbingers of trend reversals or significant shifts in market sentiment, offering early warnings that purely price-based analysis might miss. Finally, this step involves assessing the speed and momentum of price movements, critically evaluating whether these dynamics are confirmed by the other indicators. A rapid price surge on high volume and a narrowing bid-ask spread suggests strong, validated buying pressure. The market is absorbing supply efficiently and moving higher with conviction. Conversely, a slow, grinding price ascent on dwindling volume and widening spreads points to underlying weakness, a struggle to gain traction, and potentially a market that is being walked up by a few participants without broad support. This kind of movement often precedes a sharp correction. The interplay of these three elements, price, volume, and spread, provides a comprehensive narrative. If price is rising but volume is low and the spread is widening, it's a weak move. If price is consolidating, but volume is increasing on up days and decreasing on down days, and the spread is stable, it suggests accumulation. It's about building a holistic picture, where each piece of information either confirms or contradicts the others, allowing for a more robust and accurate assessment of the true market pressure. The true power of Edson Gould's three-step rule emerges not from the isolated application of each step, but from their integrated synergistic application. Each element acts as a filter and a confirmation mechanism for the others, combining to form a holistic and remarkably clear picture of the market's underlying dynamics. Imagine trying to understand a complex machine by looking at just one gear. You might understand its rotation, but not its purpose or its interaction with other components. Gould's rule ensures that you examine all the critical gears, observing how they interlock and influence one another. Volume provides the context for price. It tells you the conviction behind a move. The bid-ask spread offers a granular, real-time insight into the immediate supply-demand imbalance and the aggressiveness of participants. Price action, interpreted through the lens of volume and spread, then reveals the true momentum and sustainability of the market's direction. This integrated approach is precisely what allows traders and investors to differentiate between genuine market movements and mere noise. The market is rife with false signals, temporary fluctuations, and manipulative maneuvers designed to trap the unwary. A price breakout that appears compelling on a chart might be nothing more than a momentary surge if it lacks the backing of significant volume, or if the bid-ask spread indicates a lack of liquidity and aggressive participation. Conversely, a seemingly innocuous consolidation period might actually be a powerful accumulation phase if volume analysis reveals increasing activity on up days and diminishing activity on down days, while the spread remains tight, suggesting controlled buying. By requiring all three steps to align, Gould's rule acts as a powerful verification system, filtering out the distractions and focusing attention on the signals that genuinely matter. It moves beyond superficial pattern recognition to a deeper understanding of the market's internal mechanics. The pitfalls of ignoring even one of these three steps are significant and can often lead to costly misinterpretations. Consider a scenario where a stock's price breaks above a resistance level, a classic bullish signal. If a trader were to act solely on this price action without considering volume, they might enter a long position. However, if this breakout occurred on exceptionally low volume, it would suggest a lack of broad market participation and conviction. The lack of volume would indicate that the move is not well supported, making it vulnerable to a rapid reversal. Similarly, if the bid-ask spread widened significantly during this low-volume breakout, it would further confirm the underlying weakness, indicating that aggressive buyers are scarce and liquidity is poor, making the price highly susceptible to even small selling pressure. In this case, ignoring the volume or spread analysis would lead to a false positive, resulting in a potentially losing trade. Another example. Imagine a stock experiencing a sharp sell-off. Pure price action analysis might suggest an immediate short position. However, if this sell-off is accompanied by unusually high volume and a progressively narrowing bid-ask spread, it could signal a capitulation event. High volume could represent widespread panic selling, while a narrowing spread might indicate that aggressive buyers are stepping in to absorb the supply, suggesting that the market is finding a bottom. In this instance, ignoring the volume and spread would lead a trader to short into a potential reversal point, missing out on a rebound or suffering unnecessary losses. Gould's methodology provides a crucial safeguard against such common errors by demanding a comprehensive, multifaceted assessment before drawing conclusions about market direction. It encourages a disciplined approach, ensuring that decisions are based on a robust confluence of evidence rather than isolated observations. The advantages of diligently applying Edson Gould's method for reading market pressure are manifold and profound, offering a significant edge to those who commit to its mastery. First and foremost, it leads to a marked increase in the accuracy of forecasting market movements. By systematically analyzing volume, bid-ask spreads, and price dynamics in an integrated fashion, traders and investors gain a much clearer and more reliable understanding of the underlying forces driving prices. This moves them beyond mere speculation, enabling them to anticipate significant shifts in supply and demand with greater precision. They are no longer simply reacting to what has already occurred, but are instead positioned to understand the momentum and conviction behind future movements. This foresight translates directly into more informed decision-making and a higher probability of successful trades or investments. Secondly, this enhanced accuracy directly translates into the ability to identify optimal entry and exit points with significantly greater confidence. When Gould's rule signals strong buying pressure confirmed by all three steps, it provides a high-conviction entry point for long positions. The evidence suggests that the market is genuinely poised for an upward move, reducing the uncertainty associated with initiating a trade. Conversely, when the rule indicates waning buying pressure or increasing selling pressure, it offers clear signals for taking profits or exiting positions before a potential reversal. This ability to pinpoint critical turning points, whether for initiating a trade or managing an existing one, is invaluable. It helps traders avoid impulsive decisions based on fleeting price action and instead anchor their actions in a deeper understanding of market psychology and mechanics. Furthermore, a deeper understanding of underlying market forces, as provided by Gould's method, inherently leads to a substantial reduction in trading and investment risks. When one comprehends the true strength or weakness of market pressure, they are less likely to be caught off guard by sudden reversals or false breakouts. By identifying divergences between price and volume, or by observing shifts in bid-ask spreads, traders receive early warning signals that allow them to adjust their positions, tighten their stop losses, or simply avoid high-risk scenarios altogether. This proactive risk management, born from a more profound market comprehension, is a cornerstone of sustainable trading success. It prevents emotional decisions driven by fear or greed and encourages a disciplined, evidence-based approach to capital preservation. Perhaps one of the most compelling benefits of adopting Gould's approach is the distinct competitive advantage it confers over traders who rely solely on more superficial forms of analysis. In a market where information asymmetry can be exploited, those who possess a deeper, more nuanced understanding of market pressure are inherently better positioned, while others might be chasing after simple chart patterns or reacting to news headlines. The adherents of Gould's rule are deciphering the true intentions of the market's major players. They are seeing beyond the immediate price fluctuations to the underlying accumulation or distribution, the true conviction or exhaustion of buyers and sellers. This ability to perceive the market's hidden narrative allows them to make more strategic, less reactive decisions, often entering positions before the crowd and exiting before the herd panics. It transforms trading from a game of chance into a disciplined, analytical endeavor, where a systematic approach provides a consistent edge. In conclusion, Edson Gould's three-step rule for reading market pressure stands as a timeless testament to the power of systematic, integrated market analysis. It moves beyond the superficial, urging traders and investors to delve into the very core of market mechanics. By meticulously analyzing trading volumes, scrutinizing bid-ask spreads, and interpreting price dynamics in their holistic context, Gould provided a framework that not only demystifies the market's complex behavior, but also empowers individuals to anticipate its future movements with remarkable clarity. The true value of this rule lies in its ability to synthesize disparate data points into a coherent narrative of supply and demand, offering a robust defense against market noise and deception. This systematic approach is not merely a collection of isolated techniques. It is a philosophy that emphasizes the interconnectedness of market forces. It teaches that no single indicator tells the whole story, but that the confluence of multiple carefully chosen indicators provides an unparalleled depth of insight. Gould's legacy is a reminder that success in the financial markets is rarely achieved through shortcuts or simplistic views. Instead, it demands a commitment to continuous learning, a willingness to adapt one's perspective, and a disciplined application of robust analytical frameworks. The market is an ever-evolving entity, but the fundamental principles of supply and demand, as illuminated by Gould's profound understanding of market pressure, remain constant. Mastering this rule is not just about improving trading outcomes. It is about cultivating a deeper, more intuitive understanding of the market's true pulse, enabling a level of foresight and confidence that sets one apart in the competitive world of trading and investment. It is an invitation to engage with the market on a more profound level, to listen to its whispers and to discern its true intentions, thereby unlocking a path to more consistent and sustainable success. The journey to market mastery is ongoing, but with Gould's three-step rule as a guide, the path becomes significantly clearer and more rewarding.